Hello and welcome to Pro Trader Strategies market commentary for Tuesday, June the 7th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Not a whole lot of economic data here in the United States or across the pond. The overall markets are pushing higher though, and it could be led in part to crude oil pushing higher and above that $50 a barrel area that I've talked so much about. That is the key line in the sand. Although the resistance line looks like it's a little bit lower than that, I've been talking about it for some time, that the $50 psychological barrier is going to be key. And if we settle above that $50 a barrel area, the market could easily want to trade up into the mid-50s and even test the $60 a barrel area. If you note, that mid-50s area would cover that gap, and the overall market would want to start filling in this low volume node that we have here. But we have to settle above that $50 a barrel area to really get the shorts nervous about the upside. Onto the overall equity markets, as you can see here, NASDAQ up 4 points on the day, but off of its highs that we saw. It traded up close to 45.50, was close to the high anyway. That's what it was looking like it was wanting to go to trade to. As you can see here, it's 45.45, but the market was pushing higher and has since come off during the day session. I've talked about this time and time again. It looks to me like the market really is kind of slowing off and is going to want to start trading back down to the lower end of the range and maybe start filling in some of this low volume node area. But it's all going to be based on what the Fed does. If the Fed starts looking like they're not going to raise interest rates, the overall market's going to celebrate that and start to push higher. Right now, this is going to be very difficult for the bulls to get through this volume area. It's not exactly where price has been accepted, that is down here, but the more that we trade here, price will be accepted at these levels, and then we could easily see it want to fill in this area to make a nice big bell curve. On the mini S&Ps, as you can see here, up 8.5 points on the day, and right near the highs for the most part. The overall S&Ps are just pretty much straight up since the open. As you can see here on the daily 15-minute chart, overnight we really kind of sold off to the lows, but as soon as the market opened, rallied straight off to the upside, and have barely seen any pullback on this upside rally. We're starting to see it come off the highs created about 15 minutes ago, but at the end of the day, we are just a smidge off the highs. I know a couple trades that I've done. Biogen, I put it on for a couple of weeks ago, and I did the June 230, 290 strangle. So I'm short the 230 puts and short the 290 calls, and that's naked. But I have been tested for about a week on those 290s. It's breached the 290 calls and gone into the money several times. I haven't been breached on my break even. I did that strategy for $4.80, and so my break even on that to the upside would have been $294.80. The underlying never really traded there to really test my break even, although it was a losing position because I was in the money with 10 days to go. Today, lo and behold, Biogen plummeted off the news that their MS drug, multiple sclerosis drug, had failed clinical trials. So that really took the wind out of the sails of the bulls in this market. Anytime they have a failed clinical trial, that really crushes the stock. As you can see, they're down over 11% here, down 36 points. I covered this a little bit early, right off the bat this morning. I was just worried that we could, with that failed clinical trial, and all the hoopla around it could really go down and test my puts, which I just didn't want to see. I was right there in the mid-range of where I entered this trade. All the theta came out of it with, as you can see, the volatility came out of that with this news coming out. And I was able to cover it for $1.40. So, you know, I originally sold it for $4.80. If you watch any of my webinars and listen to me talk about these, I usually cover these at 50% of max profit, which would have been about $2.40. The reason why I didn't is because that happened all overnight. The market was a losing trade in the beginning and was able to be a winning trade today, and I just didn't want to go forward and let this play out and maybe test my 230 puts on that. So I got a great question over the weekend about why I cover at 50% of max profit, you know, and don't ride that all the way into the last couple of days to get those extra nickels out of it. And the reason why is because some news could come out in that, and the gamma really affects those price of those options in those last few days. So to me, it's not worth it. When I put on a trade with 45 days to expiration to 35 days to expiration, and I get that slope where I get 50% of my max profit right away, then there's no sense in me risking going out another 30 some odd days or 20 some odd days to capture that extra couple of nickels or dimes that could be left on the table. To me, I'd rather get out of that trade at the 50% of max profit and reallocate that money in another high probability trade going forward. So keep that in mind. That was a great question. I appreciate the feedback, and I think it's important for everybody to understand where I stand with these types of strategies. Going forward with CSCO, talking about the webinar on Friday, we did it on call diagonals, and I went into CSCO and did, this was on the put diagonals. The week before that, it was on the call diagonal, so it was a two-part series. And in CSCO, I went into the August, sold the 32 puts, and what I try to do with this strategy is finance that extrinsic value. Now, the intrinsic value is what's embedded in the option that's in the money versus where it's trading. So a 32 put should have about $2 in intrinsic value, and the rest is extrinsic value. That's where the theta decay can come in. So in order to do that, I sold the 28 puts in the July. So I financed the near-term expiration because I want to see that theta decay come out real quick, and use that to finance the extrinsic value in those long-dated August puts. So basically, I have this trade on for the intrinsic value. Sometimes you can get it for a little bit less. So my break even is right there around where we're trading at $29.09, because I only paid a debit of $2.97. The market's gone up a little since I implemented that trade, but when I implemented it, my break even was right there at where it was trading. So I'd like to get the break even there or slightly higher. So I've already achieved, or I've gotten away from my break even. I don't have to go through to the downside to achieve that break even. So that's about all I got for you guys today. Go to protraderstrategies.com, sign up for the webinar on Friday. The more the merrier. I love all the give and take back and forth, especially even in the email. So if you've signed up for these webinars and you have a question, please feel free to reach out to me, and I'm happy to answer those. That's all I got for you today. If you can't take that, take it easy.